Good day everyone, we are Group 2 and today we will be discussing Chapter 10, Financial Management and Accounting in the Global Firm, Chapter 11, Strategy and Organization in the International Firm, Chapter 12, Global Market Opportunity Assessment and Global Business Strategy. Chapter 10, Financial Management and Accounting in the Global Firm. International financial management is the acquisition and use of funds for cross-border trade, investment, R&D, manufacturing, marketing, outsourcing, and other commercial activities. It is a complex but critical business function. Firms face various international financial challenges. These arise from globalization, integration of financial markets, rise of global e-commerce, global financial crisis, and expanding opportunities to profit from financial activities. A key job of financial managers is to obtain funds from whenever in the world capital is least costly. Sources include investors in the world stock and bond markets, banks, and venture capital firms anywhere in the world. An additional source is intra-corporate financing, obtaining funds from within the MNEs or multinational enterprises operations worldwide. Managers' ability to minimize risk and seize opportunities depends on their financial management skills and their understanding of the regulations that govern financial systems worldwide. In this chapter, we will analyze the 6 financial management tasks that are critical to M&E success, such as choosing a capital structure, raising funds for the firm, managing working capital and cash flow, performing capital budgeting, managing currency risks, managing the diversity of international accounting and tax practices. Task 1. Choosing a capital structure. Determine the ideal long-term mix of debt versus equity financing internationally. The capital structure is the combination of long-term debt financing and equity financing that the company uses to sustain its global operations. Equity financing is obtained by holding onto earnings while selling shares on stock exchanges, while debt financing can be acquired by selling bonds or borrowing money from banks and other financial entities. Task 2. Raising funds for the firm. Acquire equity, debt, or intra-corporate financing for funding activities and investments. On the global capital market, businesses can raise capital for intermediate term and long-term financing. On the other hand, the global money market, the stock exchanges throughout the world where investors and businesses come together to purchase and sell shares of stock, is where equity funding for short-term financing can be obtained. Businesses can borrow money on the euro currency market, which uses money that has been banked outside of its country of origin for debt financing. On the international bond market, businesses also sell bonds, frequently foreign bonds or euro bonds. MNEs can also use intra-corporate financing to support the operations of their subsidiaries. In addition, there is a bond which is the major source of debt financing. A bond enables the borrower to raise capital by promising to repay the principal along with interest at a specified date. Global bond market is the international marketplace where bonds are bought and sold primarily via banks and stockbrokers. Foreign bonds are sold outside the bond issuer's country and denominated in the currency of the country in which they are issued, while euro bonds are sold outside the bond issuer's home country and denominated in its own currency. Example is when Toyota sells yen-denominated bonds in Europe. Task 3. Managing working capital and cash flow. Manage funds passing in and out of the firm's value-adding activities. The difference between the current assets and current liabilities is known as net working capital. Businesses frequently create a central repository where funds from all of the firm's subsidiaries and affiliates are pooled and distributed to departments in need of funding. Dividend remittances, royalties, transfer pricing, and fronting loans are a few of the different ways that money can be moved within an M&E. A fronting loan is a financial contribution made by a parent company to a subsidiary that is routed through a bank or another financial middleman. By removing the compensating cash flows between these organizations, a procedure known as multilateral netting reduces the number of financial transfers between the parent and subsidiaries strategically. Tax havens are nations with low taxes that welcome foreign investment and business. These are the following methods in transferring funds within the MNE. Trade credit is a subsidiary that defers payment for goods and services received from the parent. Royalty payments are remuneration paid to the owners of intellectual property, as parents often license the use of assets to subsidiaries. Fronting loan is a loan between the parent and its subsidiary channeled through a bank. The parent deposits the sum in a foreign bank, which then transfer the funds to the subsidiary as a loan. And the transfer pricing is the prices that subsidiaries and affiliates charge one another for transferred goods and services within the same MNE. Task 4. Performing capital budgeting. Assess financial attractiveness of major investment projects like foreign market expansion. The foundation of capital budgeting is the analysis that management conducts to gauge the viability of suggested global projects. Capital budgeting helps the managers to decide which international expansion is worth it to do due to the potential profit. So in order to determine if a given project should be carried out, management computes its net present value. Task 5. Managing currency risk. Manage multiple currency transactions and exposure to exchange rate fluctuations. Currency trading takes place between banks and currency brokers, often on behalf of multinational firms. There are currency traders including hedgers, speculators, and arbitrators. Managers attempt to forecast exchange rates to minimize their firm's exposure to currency risk. Approaches for minimizing exposure to currency risk include centralizing currency management, measuring currency risk, monitoring long-term trends, and emphasizing flexibility in international operations. Firms also employ hedging, the use of specialized financial instruments to balance positions in foreign currencies. Key hedging tools include forward contracts, future contracts, currency options, and currency swaps. There are three main types of currency exposure: transaction exposure, economic exposure, and translation exposure. A firm faces transaction exposure when outstanding accounts receivable or payable are denominated in foreign currencies. Economic exposure results from exchange rate fluctuations affecting the price of products, the cost of inputs, and the value of foreign investments. While translation exposure arises as the firm combines the financial statements of foreign subsidiaries into the parent's financial statements, a process called consolidation. Task 6. Managing the diversity of international accounting and tax practices. Operate in a global environment with diverse accounting practices and international tax regimes. Financial statements prepared in one country may be difficult to compare with those from other countries. Through transparency, firms regularly and comprehensively reveal reliable information about their financial condition and accounting practices. Various factors account for differences in national accounting systems. Several international organizations are aiming to harmonize cross-national accounting practices. Managers use the current rate method and the temporal method for currency translation. Internationally, firms seek to minimize taxes, which consist of direct taxes, indirect taxes, sales taxes, and value-added taxes. Governments use two major methods for eliminating multiple taxation: the foreign tax credit and tax treaties. In managing the diversity of international accounting and tax practices, it is important to follow transparency and financial reporting. Transparency is the extent to which businesses routinely and thoroughly disclose significant information about their financial situation and accounting procedures. Actually, the federal government passed the Sarbanes-Oxley Act in 2002, which holds CEOs and CFOs personally accountable for the integrity of annual reports and other financial data in an effort to promote openness in the United States. Internationally, accounting rules are generally becoming more uniform.
Introduction. Internationalization of firms is a huge step and requires a significant effort to become successful in foreign countries. It includes stabilizing the organizational structure to become scalable and fit for the global competition. Formulating effective strategies are crucial as well in defining the competitive international market. Let's define first what is strategy. Basically, strategy is a set of actions that managers employ to make best use of firms' resources and core competencies to gain competitive advantage. Perhaps strategies are critically planned in order to leverage resources effectively or acquire superiority in the market competition. When it comes to international strategy, it is formulated to carry out two or more countries, meaning to say, strategies for internationalization must be considering potential and broad factors. International business managers design worldwide value adding activities, allocate limited company resources, engage in significant international marketplace, forge advantageous international alliance, and wage competitive war against international adversaries. And they advise strategies to bolster and preserve the business's competitive advantages. If there is a strategy, objective and goals must be set to achieve success in competition. Here are the three strategic goals that must simultaneously pursued. One is efficiency. It refers to lowering the cost of the firm's operations and activities on a global scale. Companies that have numerous value chains must take extra attention in how they set up their production, research and development, product sourcing, marketing, and customer service divisions in order to develop effective global value chains. Two is the flexibility. It is the ability of the firm to create global adaptability to take into account in various countries' specific possibilities and threats. Managers must be skilled at leveraging local resources and opportunities in the locations where they conduct businesses, since international contexts can be challenging. It can be accomplished by the creation of commercial relationships with independent suppliers and distributors in certain nations, the promotion of foreign direct investment in others, or by modifying its marketing and human resource policies to suit unique national conditions. Last is learning. It refers to the firm's capacity to benefit globally from the lessons it learned from operating in a global environment. A company may gain knowledge over the course of doing international business, which is one of the advantages. This includes new product concepts, management and technical expertise, improved research and development capacities, partnership skills, and the capacity to endure in the strange circumstances. Building a global firm must have these dimensions. First, visionary leadership. Visionary leaders are those who demonstrate exceptional creativity, discipline, and enthusiasm when guiding others towards the achievement of their vision. In business, with significant worldwide operations, leadership is more difficult and complex, and hence, Firms must have a visionary leaders that show exceptional creativity. And second, organizational structure. It is the set of widely recognized principles, rules of conduct, and other frameworks that staff members learn and follow. It enables teams to collaborate on tasks within confines of their respective responsibilities. Organizational processes. It is the procedures, attitudes, and techniques used by managers to make the business run as it should be. Mechanisms for gathering strategic data, assuring the manufacturing quality control, and upholding effective payment systems for global sales are the typical processes which are done by the firms which operate internationally. Now we have here is the integration responsiveness framework. Global integration is the coordination of a company's value chain operations across numerous nations. Contrary to global integration, many businesses aim to react to particular circumstances in many nations. Multi or multi-domestic industries are where you'll frequently find them. Local responsiveness places our focus on catering to the unique needs of clients in local marketplace. Global integration maximizes global effectiveness, synergy, and cross-fertilization and to capitalize on a nation's similarities. When firms conduct business globally, they strive to find the ideal balance between the goals of local responsiveness and global integration. This is when they use the integration responsiveness framework. They said framework summarizes the balance that firms seek to achieve between two basic strategic needs. One is the need to integrate value chain activities globally, and second, the need to create products and practices responsive to local market needs. With the integration responsiveness framework, here are the four strategies derived from the framework. One is home replication strategy. The company sees its overseas business as a distinct from and secondary to its domestic operation in the home replication strategy. Second is the multi-domestic strategy. It is a more advanced strategy in which a company expanding internationally and creates subsidiary or affiliates in each of the multiple overseas markets. Under this strategy, the products and services are adopted to suit the needs and wants of buyers in each country. Third is a global strategy. With a global plan, headquarters aims to exert significant control over its country operations in order to reduce duplication and achieve the highest levels of effectiveness, learning, and integration globally. A global strategy places a focus on centralizing coordination and management of worldwide operations. The majority of the time, headquarters managers are in charge of all global activities for the company. Third is transitional strategy. A transitional strategy is a planned approach to internationalization where the company aims to somewhat receptive to a local demands while maintaining a sufficient amount of central control to ensure effectiveness and learning. It minimizes the drawbacks of the multi-domestic and global methods when combining their main benefits. Now, we will proceed to the organizational structure in an international firm. Organizational structure describes the reporting relationships inside the firm or the boxes and lines that specify the links between people, functions, and processes that allows the firm to carry out its operations. A fundamental issue in organizational structure is how much decision-making responsibility the firm should retain at headquarters. how much should be shared, and how much it should delegate to foreign subsidiaries affiliates. Organizational structure could be centralized or decentralized. Centralized approach offers headquarters considerable authority and control over the firm's global activities. For instance, the Panasonic Incorporated. Their highest authority is based in Japan headquarters, and its subsidiaries around the globe are following the orders from the headquarters. Somehow, the decentralized approach means that the substantial autonomy and decision making authority are distributed to the firm's subsidiaries worldwide. A great example of this is the BPO companies. These companies had their own branch director and regional head in every country, which has an autonomous decision on their operation in the whole company, but with accordance to the general VMGO of their mother company. As the firms engaged in international business grows, it adopts more complex organizational structures. There are major types of organizational structure. Number one is the export department. It is the unit within the firm that is in charge with managing the firm's export operations. In this structure, it is managed by a single department. Selling, distribution, and shipping are efficient. It focuses on the domestic market and has minimal control in international operations. Second one is the international division structure. All international activities are centralized within one division in the firm, separate from domestic units. As the firm's foreign activities develop, an international division structure must be established, creating a separate entity inside the firm's dedicated to administering its international operations. This structure can lead to a domestic versus international power struggle over limited corporate resources such as financial and human resources. Third is geographic area structure. It is an organizational design in which management and control are decentralized to the level of individuals' geographic regions. The structure is decentralized because headquarters management delegates operation for each local to the respective regional managers. The area managers have the power to change products and strategy. It is mostly used by industries with narrow product lines such as pharmaceutical, food, automotive, cosmetics, and beverage industries. Fourth is the product structure. It is an arrangement in which management of international operation is organized by major product line. Each product division is responsible for developing and marketing a center category of products on a global scale. For example, we have Apple products categories include the iPod, iPad, iPhone, and personal computers. Fifth is the functional structure. A centralized structure in which management of international operation is organized by functional activities such as production and marketing. The benefits of using a factional division includes a small central staff that offers a strong centralized coordination and control. For instance, is the oil companies often arrange their international operations along two key functional lines. For number six, the global matrix structure. This is a structure that combines geographic area, product, and functional structures to take advantage of a purely global strategy while being responsive to local demands. The geographic area structure is effective for fulfilling local demands but did not or did nothing to improve global economies of scale. The product structure overcame these flaws, yet it was insufficient in meeting local needs. M&E managers realizes that such changes required them to address global and local demands simultaneously. It has resulted in the development of global matrix structure. And this global matrix structure aims to maximize the benefits of global strategy while being responsive to local demands. Firms create a dual reporting structure in which, for example, an employee at a foreign subsidiary reports to two managers and the general manager of the local subsidiary and the corporate product division. The selection of an entry strategy is one of the most crucial choices management makes in the international business. Three sorts of foreign market entry methods exist. First is the trade of products and services. Generally, this is a home-based international exchange activities, and these are importing or global sourcing, known as a global procurement or global purchasing. It is a strategy of buying products and services from foreign resources and bringing them into the home country or a third country. Next is the exporting, producing products or providing services in one country, usually the producer's native country, and selling or distributing them to customers in other countries. Now, third is the counter trade, international transaction in which payment is made in kind rather than cash. In exchange for payment, the firm receives other products. The second method is equity or ownership based international business activities. Commonly are the foreign direct investment and equity based collaborative ventures. Unlike domestic international operations, the firm creates a physical presence in the foreign market here. The foreign direct investment is establishing presence in a foreign market, involves investing capital and acquiring ownership of a factory or subsidiary or other facilities. While the collaborative ventures includes joint ventures in which the firm makes comparable equity investments overseas but in partnership with other company. The third method is contractual relationships. Typically, it takes the form of licensing and franchising rather. Licensing enables a foreign partner to exploit its intellectual property in exchange for royalties or other compensation. While franchising is common in retailing, it is used by companies such as McDonald's, Dunkin' Donuts, and Century 21 Real Estate to offer customers in other countries. When internationalizing firm, it needs to follow a control. It is the ability to influence the decisions, operations, and strategic resources engaged in a foreign venture. When two parties pursue their own objectives, conflicts frequently arise that makes it difficult for the main firm to carry out strategy, coordinate operations, and solve them without control. Here are the different control strategies. Low control strategies. These are exporting, counter trade, and global sourcing. Next is the moderate control strategies. These are the contractual relationships such as licensing and franchising and project based collaborative ventures. Lastly is the high control strategies. These are equity joint ventures and FDI. The focal business achieves maximum control by establishing a physical presence in the foreign market and acquiring ownership of important assets. Let us now unveil the stages of internationalization. First, domestic market focus. Exploit home market opportunities. Firm operates only in its home market due to limited resources or lack of motivation. Second, pre-internationalization stage, wherein research and evaluation the feasibility of undertaking international business activity. Third is the experimental involvement. Initiate limited international business activity, typically through exporting. In this stage, the manager considers foreign market opportunities attractive. Fourth, active involvement. Explore international expansion, including entry strategies other than exporting. The manager's accumulated experiences reinforce expectations about the benefits of international business. Managers commit further resources to international expansion and dedicate more resources to expand into new foreign markets. Fifth is committed involvement. Allocate resources based on international opportunities. The firm performs well in various international ventures and overcome barriers.
Chapter 12, Global Market Opportunity Assessment. As more managers know about an opportunity, the better equipped they will be to exploit it. To skillfully navigate international markets, managers require substantial information on potential threats and opportunities and how to conduct business abroad. As defined, a global market opportunity is a favorable combination of circumstances, locations, and timing that offers prospects for exporting, investing, sourcing, or partnering in foreign markets. Under such conditions, the firm may perceive the opportunities to sell its products and services, establish factories and other production facilities to produce offerings more cheaply or competently, procure raw materials, components, or services at lower cost or of better quality, and enter beneficial collaborations with foreign partners. Global market opportunities can enhance company performance, often far beyond what the firm can achieve in its home market. There are six processes especially appropriate for pursuing marketing or collaborative venture opportunities abroad. And these are the following tasks. But to understand them better, we will highlight the discussion of their objectives, outcomes, and criteria. The first task is analyzing organizational readiness to internationalize. Before going global, the company should analyze its readiness first. Organizational capability evaluations are important for both new and experienced multinational businesses. A self audit is like SWOT analysis, which evaluates a company's strengths, weaknesses, opportunities, and threats. Its objective is to assess the company's readiness to conduct international business activity objectively. For the outcomes, it is expected to provide a list of the company's strengths and weaknesses in terms of doing business internationally, along with suggestions for fixing problems that get in the way of achieving organizational objectives. For the criteria, the following must be met: relevant financial and tangible resources, relevant skills and competencies, and senior management commitment and motivation. A formal analysis of organizational readiness to internationalize requires managers to address the following questions. What do we hope to gain from international business? Objectives might include increasing sales or profits, following key customers who locate abroad, challenging competitors in their home markets, or pursuing a global strategy of establishing production and marketing operations at various locations worldwide. Is international expansion consistent with other firm goals now or in the future? The firm should evaluate and manage internationalization in the context of its mission and business plan to ensure that it represents the best use of the company's resources. What demands will internationalization place on firms' resources, such as management, human resources, and finance, as well as production and marketing capacity? Management must ensure that it has sufficient production and marketing capacity to serve its foreign markets. Lastly, what is the basis of the firm's competitive advantage? Companies seek competitive advantages by doing things better than their competitors. Competitive advantages can be based on strong R&D, superior input goods, cost-effective or innovative manufacturing capacity, skillful marketing, and others. The second task is assessing the suitability of products and services for foreign markets. After confirming the company's readiness to internationalize, management evaluates its products and services for foreign markets. Most companies have a portfolio of products that may be exported. Other corporations develop products for international markets. The objectives are to conduct a systematic assessment of the suitability of the firm's products and services for international customers and to evaluate the degree of the fit between the product or service and customer needs. For the outcomes, it is important to determine the factors that may hinder product or service market potential in each target market and identify the needs for the adaptations that may be required to initial and ongoing market entry. The following criteria should be taken into consideration when evaluating the firm's product and services: foreign customer characteristic and requirements, government mandated regulations, expectations of channel intermediaries, and characteristics of competitors' offerings. Products or services with the best international prospects tend to have one or more of the following characteristics: sell well in the domestic market, cater to universal needs, addressing a need which is not well served in particular foreign markets, and addressing a new or emergent need abroad. The third task is screening countries to identify target markets. Its objective is to reduce the number of countries that warrant in-depth investigation as potential target markets to a manageable few. For the outcomes, there should be an identification of 5 to 6 high potential country markets that are most promising for the firm. And here are the criteria that should be met: market size and growth rate, market intensity, which is the buying power of the residents in terms of their income level, consumption capacity, which is the size and growth rate of the country's middle class, country's receptivity to imports, infrastructure appropriate for doing business, economic freedom, and political risks. For screening countries for exporting, exporters first examine such criteria as population, income, demographic characteristics, and government stability. There are two basic screening methods. First is the gradual elimination, where there are large number of prospective target countries that are gradually narrowed by examining increasingly specific information. Therefore, from macro information to micro level. Next is the indexing and ranking. Here, scores get assigned to countries for their overall market attractiveness. Market potential indicators are used as one or more variables. The fourth task is assessing industry market potential. Industry market potential is an estimate of all firm sales during a given period. It is different from company sales potential, which is the firm's share of industry sales in a given year. Its objective is to estimate the size of relevant industry sales within each target country. It also aims to investigate and evaluate any potential barriers to market entry. The expected outcomes are 3 to 5 year forecasts of industry sales for each target market and delineation of market entry barriers in industry. The following are the criteria that should be met: market size, growth rate and trends in the industry, the degree of competitive intensity, tariff and non-tariff trade barriers, standards and regulations, availability and sophistication of local distribution, unique customer requirements and preferences, and industry-specific market potential indicators. Managers use various methods to estimate industry market potential. The simple trend analysis, which provides a rough estimate of the size of current industry sales in the country. Monitoring key industry specific indicators. Here, the manager examines unique industry drivers of market demand by collecting data from various sources. Monitoring key competitors. Here, the manager investigates the degree of major competitor activity in the countries of interest. Following key customers around the world. For example, automotive suppliers can anticipate their future markets by monitoring the international expansion of their customers such as Honda or Mercedes-Benz. Tapping into supplier networks. Many suppliers serve multiple clients and can be a major source of information about competitors. Firms gain valuable leads from current suppliers by asking them about the activities of competitors, as long as the questions are ethical and don't expose competitors' trade secrets and other proprietary information. Lastly is by attending international trade fairs. By attending a trade fair in a target country, the manager can learn much about market characteristics and other factors that indicate industry sales potential. Trade fairs also help identify potential distributors and other business partners. The fifth task is choosing foreign business partners. Its objective is to decide on the type of foreign business partner, clarify ideal partner qualifications, and plan the mode of entry. The outcomes expected are determination of most suitable types of foreign business partners, list of attributes desired of foreign business partners, and also determination of value-adding activities that foreign business partners contribute. The following criteria should be met: manufacturing and marketing expertise in the industry, commitment to the international venture, access to distribution channels in the market, financial strength, quality of staff, technical expertise, and infrastructure and facilities. When screening for potential foreign distributors, the firm looks for the following. First is financial soundness and resourcefulness to guarantee that the venture receives the right amount of support both initially and in the long run. Next is competent and professional management with qualified technical and sales staff. Next is solid knowledge in the industry with access to distribution channels and end users in the marketplace. Next is reputation in the industry and solid ties to the community's government. And lastly, commitment, loyalty, and a readiness to put money into the business and help it develop over time. The last task is estimating company sales potential. This task is often much more challenging than the earlier tasks. It requires the researcher to obtain highly refined information from the market. Its objective is to estimate the most likely share of industry sales the company can achieve over a period of time for each target market. For the outcomes, it is expected to have a 3 to 5 year forecast of company sales in each target market. It is also expected to have a great understanding of factors that will influence companies' sales potential. The following criteria should be met: capabilities of partners, access to distribution, competitive intensity, pricing and financing, market penetration timetable of the firm, and risk tolerance of senior managers. This is the framework for estimating company sales potential in the foreign market. Customer characteristics, competitive positioning of local brand, competition, pricing, channel effort and productivity, and customer receptivity are all contributing to company sales potential. With this, we can say that estimating company sales potential is more of an art than a science. The process of estimating company sales is more like starting from multiple angles and then converging on an ultimate estimate that relies heavily on judgment. Often, managers prepare multiple estimates based on the best case, worst case, and most likely case scenario. Arriving at such estimates will require assumptions as to the degree of firm effort, price aggressiveness, possible competitive reactions, and degree of intermediary effort.
Global business strategy. In order to break into the international market, one must first build a worldwide strategy using a global strategy. The globalization of sales is the end goal that should be aimed for when developing a worldwide strategy. The phrase global strategy encompasses not only standardization but also international and multinational approaches to business as well. In summary, these three strategies are beneficial to a firm in helping it achieve its objective of worldwide expansion. When developing a global strategy, it is useful to make distinction between three different forms of worldwide expansion that come from a company's resources, capabilities, and present economic position. When designing a worldwide strategy, consider how your company's product will perform internationally. Developing a worldwide strategy involves assessing your company's rivals, overseas clients, production facilities, and other issues. A well-developed global strategy can help your organization expand revenue and boost brand recognition. So here are the types of global strategies. First in line is standardization strategy, which is a strategy designed by a company to expand its operational procedures into the international market. When you utilize a standardization plan, you sell the same things everywhere you sell them. A standardized plan preserves central command rather than delegating decision-making to regional markets. A standardization strategy can help you generate products faster and simply coordinate operations across multiple locations, among other benefits. A dairy company, for example, may sell some of its excess milk and cheese supplies outside of its own country. However, the local market remains its key strategic focus. Next strategy is international strategy. Globalization involves importing and exporting things. Using an international approach allows you to interact with worldwide suppliers and sell to global clients while preserving domestic locations. While doing business abroad, international plans usually focus on the company's home market. Imagine developing a global strategy for your high-end handbag firm. You'd still do some business abroad, but your approach would focus on your home country. Even if you exported purses, they'd be distributed in your own country. And lastly, multinational strategy, which uses a global strategy that helps you to adapt your products to each specific local market. You can also have staff employees from all over the world and actual business sites. The ability to customize your business to individual locations is the primary benefit of implementing a global strategy. Assume your high-end handbag company wanted to build a global strategy. As part of a worldwide marketing strategy, you may create a one-of-a-kind luxury handbag for each market in which you sell. After that, you can customize your company to make numerous markets it serves. So why is the global strategy important? When seen from a business perspective, expansion into new markets presents the opportunity for increased sales and profits. Because of the low profitability of the domestic market, it is possible that overseas expansion is the only way to achieve profitability in some situations. On the other hand, the scope and economies of scale and scope that will be acquired from a wider worldwide base will result in lower price for goods and services from the perspective of the consumer. In addition to increased sales opportunities, there are far more reasons to expand beyond the home market. The process through which oil and gas companies expand to find more sources for their products is known as resource seeking. When clothing companies expand to take advantage of low labor costs in certain countries, this is referred to as efficiency seeking. Strategic asset hunting is the practice of some businesses acquiring foreign firms in order to boost their market position relative to competitors. Next topic is the benefit of a successful global strategy. Global brand awareness. By adopting a worldwide strategy, you may increase the global visibility of your brand. As you enter a global market, you may obtain worldwide recognition. Using a global branding approach has a variety of additional benefits, including improved message consistency, lower marketing costs, and increased brand awareness among customers all around the world. Next is generate new sales. One of the primary benefits of adopting a global strategy is the ability to increase revenue by operating in new markets. When you enter a global market, you might enhance the sales of your current products. By implementing a global strategy, you can also gain access to new markets, which includes regions of the world with increasing economies and developing marketplaces. By entering new markets, your company can increase its sales and earnings. Next, increase operational flexibility. Another advantage of developing a global strategy is the opportunity to increase operational flexibility. If you operate in a global market, you may be able to easily adjust your output. When you have a worldwide plan, you can change your production method, outsource your manufacturing, work with other companies, promote your products in different regions, and more. Next, lower labor cost. Another advantage of adopting a global strategy is the ability to take advantage of lower labor costs. In other nations, some companies incorporate efficiency-seeking strategies into their long-term goals in order to cut labor costs. Efficiency seeking, which seeks to gain from cost differences in locations other than a company's home country, can help enterprises drastically reduce expenses while increasing revenues. A global corporation may assign additional responsibilities to the national teams that are most effective at accomplishing each assignment. When each team focuses on the work for which it is the best suited, the overall level efficiency rises and time expenses fall. Scale economies. By entering the worldwide market, your company may be able to benefit from economies of scale. Economies of scale occur when a company reduces its expenses as a result of increasing output and efficiency. As a result, your company may be able to reduce production costs while increasing earnings. Access to new resources. A worldwide strategy may also assist your company in leveraging new resources. Some companies seek to establish a worldwide strategy in order to find new resources in other parts of the world. This frequently allows organizations to use lower rates of resources and lowering expenses and increasing revenues. There are three keys for a successful global business strategy. First, to define the core business strategy for each strategic business unit in a company. Second, to adapt the core business strategy to each national market. To internationalize the core strategy, the fact that local business tactics often differ significantly between nations as a result of globalization should also be taken into account. This variation may have an impact on the company's cost structure, product quality, and competitive advantage at the global level. Third one is to counteract the weaknesses created by internationalization of the core strategy by incorporating the original unique characteristics of the business into each local national strategy. We might refer to this process as globalization. A global company should strike a balance between local responsiveness and global consistency. Local responsiveness can boost competition at the local level, while global consistency can considerably raise advantage and strategic edge for the firm at the global level. Thus, it is essential to refrain from over-globalizing or under-globalizing.